Hey guys, it's been about 15 weeks since I started this portfolio, and in today's video, we're going to be doing something a little bit different, where I'll be doing a 3-month review on this portfolio since it's been about 3 months since I started. I'll be giving you some highlights as well as some lowlights, and talk about a few lessons learned. At the end of this video, I'll go over what stocks I bought last week and what I'm going to be planning to buy next week as well. Hopefully you guys enjoy this, and if you do, remember to leave a like down below. So starting off here on my portfolio metrics tab, we can see the portfolio risk, how I've allocated my positions. About 25% of it's in high risk stocks, 36.6% in medium risks, and 38.4% in low risk. And if we're looking at the number of stocks that pay, or percentage of stocks that pay dividends versus percentage of stocks that don't pay dividends, we're at a 59 and 41 split. We can see all the holdings here by percentages. The largest holdings right now are Power Corp of Canada, Enghouse, Kinaxis, Algonquin Power Corp, as well as the Bitcoin ETF. And in terms of sector weighting, we can see that I'm a bit more skewed towards finance, technology, and I guess renewables, you could say. Looking at some of the portfolio metrics here, the total market value right now is $4,784. The total book value is a little higher at $4,823. This means my portfolio is down about by 0.81%. And if we're going to compare this to the TSX index, I'm actually down 6.51%, because the TSX index has changed about 6.62% since I started this series. The way that I'm comparing against the TSX index is actually calculating if I were to take the money that I deposit into a specific stock and put it into the index instead, how many units would I be able to buy, and track the number of units I would have had in the TSX index if I bought that instead of my holdings. If we're looking for a dollar term, I'm down about $333 compared to the index. And this would be the current portfolio value. If I did buy the index instead, it'd be $5,117. Now looking at the dividend yield on my portfolio right now, the total estimated yearly dividends is $90.46. So far, I've collected about $10.15 in dividends, and this gives me a yield as a percentage of the portfolio at 1.89%. Now jumping over to the portfolio itself, I've sorted it based on the percentage return. So you can see here that my top 3 holdings, the first one is Power Corp of Canada. And the reason why I bought into the stock initially is because of their investment in Wealthsimple trade, as well as their net asset value is significantly higher than their actual price. Currently, their net asset value as of March 31st sits at $45.94. Going back over to the portfolio, we can see the current price is $40.31. Now, the net asset value is as of March 31st, and I believe as of today, if we're looking at it June 27th, these holdings that they have, Lifeco, IGM, and GBL, have all increased since March 31st, meaning that the net asset value should likely be higher than $45.94, because these 3 are the major holdings in the actual company itself. The other investments that they have are smaller, and one of their investments is Wealthsimple Trade as well. Wealthsimple Trade recently had a couple rounds of financing, and the value of the company went up, meaning that the investment that Power Corp Canada had in Wealthsimple Trade also went up. Their Wealthsimple investment falls under this investment line here at $1.8 billion, but this is not all Wealthsimple. They have a few other corporations that they've invested in down here. The second holding that's doing the best in this portfolio is RioCan. Now looking at RioCan stock, pre-pandemic is trading at $27, and in the thick of the pandemic, it dropped as low as $13 per share. When I started buying it, it was basically mid-March. I bought it for around $19.50 per share, and ever since then, the stock has been going up. So we can see this. I believe RioCan is going up just because Ontario as a whole is moving towards opening up the economy. And that's what investors are banking on when they're purchasing RioCan in the past couple of months. The stock price is pretty low compared to the pre-pandemic price. And they've also been collecting a decent amount of rent. They showed that they collected 94% of the rent that they should have collected, so they're missing about 6%. But if we look at how much they are down compared to pre-pandemic, they're down 20%. There may be some other underlying factors as to why investors are not as bullish on RioCan, pushing its stock price past its pre-pandemic prices, but Hopefully, maybe in the next couple of years, we should see the stock rebound to pre-pandemic prices. Now, the third stock that has done the best in my portfolio is Telus. Looking at Telus' stock chart, we can see that this company, over its entire lifetime, is a fairly steady stock and is trending upwards. See, at the beginning in 1999, it's only gained about 159% over the 22 years or so. That's not a very phenomenal gain, but if you factor in dividends into that, I'm sure the stock has probably returned maybe 300 or 400, even 500%. The one good thing about Telus and why I bought into it is because of its dividend yield at 4.6% right now. It has a reasonable P ratio of 30. Maybe this is a little bit high. However, I think this company is a good staple company in my portfolio that generates cash that I can use to invest in other companies or buy more Telus shares. The reason why I chose Telus out of the 3 telecom companies is because I use their service Public Mobile. And I love Public Mobile just for the affordability of their prices. You can see here you can get 500 megabytes of data for $25. And you can get an extra 500 megabytes if you're auto paying. And with auto pay, other perks you get are $2 off your monthly bill. So this becomes effectively $23 per month. And every year that you're with them, up to 5 years, you get an extra $1 off. So you can reduce your plan price down to $18 after being with Public Mobile for 5 years. If you're interested in signing up, I do have a link down below that will give you about $10 in credit, so you can check that out if you want to switch your cell phone plan or are looking for a new provider. Now, flipping over to the other side of my portfolio, we can see the stock that's doing the worst is the Bitcoin ETF. And when I first started buying this a couple months ago, I stated my thesis for the Bitcoin ETF is that the final bull run for Bitcoin will happen later on this year. And later on this year has not come yet. However, Bitcoin has dropped 24.9%. So to any new investor, a negative 24.9% return in your portfolio could be very scary. And that's losing me $116 on paper right now. However, as I said, my thesis is that the bull run has not finally come to an end yet. And I think that we're still in a bit of a consolidation period just before the final run up, which should happen later on this year, maybe September to November timeframe. And I've studied the Bitcoin charts and I'm comfortable with this thesis and comfortable with holding onto the Bitcoin ETF and even averaging into it. And at the end of the day, if this doesn't end up playing out, I know that anyone who's held Bitcoin for 4 years or longer has never lost money. Looking at a few data points about the Bitcoin ETF, first one is Google Trends. Back in 2017-2018, the search volume for Bitcoin peaked, and we have still not hit those search volumes, although we have come close. I expect search volumes to be higher in this Bitcoin bull run, just because more and more people should have heard about it and will be searching about it when the final bull run is coming. The second chart that I want to show you guys is the stock to flow model. In the stock to flow model, every time that it comes up to the next level, we can see that the Bitcoin price peaks above it and drops back down. Currently, we haven't peaked above it, and I'm expecting the same thing to happen this time, just that we're in a bit of a lull right now with a lot of FUD around Bitcoin being banned in China and stuff like that. The stock that I'm down on the second most is Good Nature Products. And here there's a lesson learned. When I bought Good Nature Products, looking at the transactions tab, we can see that I bought 100 shares at $1.20 per share. This is a pretty hefty buy for this company as an initial starting position. I probably should have dollar cost averaged a bit more into the stock and not jumped in to my target allocation. So right now, Good Nature Products, I've added about 60 shares after my initial purchase of it. And I don't plan to increase this much more, maybe to about 4% of this portfolio at most. And you can see that I'm down about 11.52%. So buying that initial 120 shares all at once was probably a mistake that I made in this portfolio, and I probably should have dollar cost averaged into it over a couple months instead of just all at once. The third stock that I'm down the most on is Enghouse Systems, and I'm down about 7%. For Enghouse, if we look at the stock chart here, we can see that when the pandemic hit, the stock dropped. However, it quickly gained a lot of momentum, shot up to close to $80 per share. At one time, it did touch that and came tumbling down. And the reason why I believe it came tumbling down is because executives were selling the shares right around here. If we go into SETI, we can see that a lot of executives were selling the shares at about $70. So if I just scroll down, you can see that people are selling at $50, $70, $75. We can even see the CEO further down here. He started selling shares in April when the stock was recovering and actually reached pre-pandemic highs of $52 per share, 67, 70. He sold at 76, 77. He sold 85,000 shares there. So he was selling quite heavily when the stock was at the high 70s. However, his most recent sale was in March, where he sold at $62 per share. Enghouse today trades at $55 per share, so it looks like the CEO has stopped selling his shares and believes that Enghouse is worth holding around these prices. In Enghouse, if you're looking at it from a business standpoint, it's got a solid business and is generating good positive cash flow. They also pay a dividend. Now, I think another reason why investors are a bit hesitant with Enghouse right now, and there's a huge drop in April, is because they saw this one line here on the revenue where it's declined about 16.7%. But if we go over to management's assessment, why this happened, it's because that their video business has returned to levels that are more consistent with pre-COVID volumes. When remote work first started hitting us and all companies shut down, the visual computing solution space was on fire, and their video business was doing very well. However, now that people are starting to return back into work, maybe businesses are starting to cancel their licenses of video, and therefore the video business has returned to pre-COVID levels, meaning that the revenue from this business unit is going back down to pre-COVID levels. So that's why we saw a drop in the revenue from $140 million in a quarter to about $117 million. However, we should also note that the cash flows from operating activities, despite the decline in revenue, were about on par at $84 million compared to $85 million. So this is a positive sign for the business that they're still cash flowing or getting $84 million of cash into their bank account compared to just $85 million. So about a $1 million difference. Another thing for Enghouse is that they've renewed a normal course issuer bid, meaning that the company is able to purchase up to a maximum of 3 million common shares and canceling them out, which represents about 7% of the publicly listed float. And Enghouse will be buying shares when they believe that the share price is attractive at such times, which ultimately reduces the total number of shares, making each share that you own to represent a larger percentage of the company. I also want to talk about this stock here, Stella Jones, which I ended up selling off. I bought into Stella Jones at the very height of lumber prices going berserk. I think this was a mistake on my part, buying into a lumber company when the prices were extremely high and thinking that it would continue going higher or holding steady. I think also coupled with the fact that I never really invest in commodities and jumping into this head first was another thing that played into the fact where I lost money on this position. So this is a lesson learned for me, not to buy in at all-time highs in a sector that I've never had experience in. One last thing that I want to point out here is that we can see more than 50% of my positions are actually up in terms of a percentage of return. But as I showed you earlier, my portfolio is actually down compared to its book value. And that's because I have the Bitcoin ETF, which makes up a large loss for this portfolio. As a slightly more seasoned investor with about 5 years under my belt and about 15 years total doing other investments, I'm not too worried about this 24% decline in my portfolio. This is quite normal even under corrections, and Bitcoin right now is in a correction. Now turning over to the short term, what did I do last week? In the past week, I bought some more Bitcoin ETF, and unfortunately, I did not catch it at $5.35, which I actually had a buy order in for. That never went to fruition, so I ended up picking up some more shares at $6.18 and $6.47, all of which are below my cost basis of $7.90 right now. I also added one share of Enghouse, as this is also below my cost basis. And finally, I bought into my stock that I talked about last week, Data Communications Management Corp. I bought in at $1.40 per share. I bought 50 shares for a total purchase price of $70. I made a video on this stock yesterday, so if you want to check that out, I highly recommend if you're interested in the stock. I do have high convictions that this stock could go from $1.40 to about $3.44 based on a valuation that I show in that video. I'll leave a link in the description down below if you want to check that video out, or it will be on the end screen at the end of this video. Two other stocks that I bought this week were Good Nature Products as well as Algonquin Power Corps. So see here, I averaged into Good Nature Products at $1.03, which is roughly around 15% lower than my cost basis currently. As for next week, what I'm aiming to do is buying some more Air Canada. Right now, I'm down about $2 per share on this position, so I'm looking to add a few more shares and bring this weighting up to about 5% in my portfolio. I'm also looking to add more DCM. Currently, it makes up about 1.42% of this portfolio, and I do think that this company could actually double or even triple in the next year. And I'm hoping to bring this up to about 5% of this portfolio. And I'm not going to make the same mistake that I did with Good Nature Products in buying all at once. I'm going to be averaging in. So that pretty much does it for this week's video. Let me know what your thoughts are down below on this portfolio. Are there any other stocks that you think I should add to this portfolio? I'd love to hear your bullish thesis on other stocks because I'm always looking for new stocks to invest in or even just to look at and understand from a fundamental standpoint. I'll be throwing up 2 videos. One of those will be on DCM, so if you're there, I'll see you there. If not, keep up the grind and have a great day.